Hey, Rent to Retires, it's Adam Schroeder here with another episode, and I am joined today by founder and CEO of Rent to Retirement, Zach Lemaster, and we are happy to be joined today by Troy Eckard. He is the chairman of the board for Eckard Enterprises. Troy uses his 4 decades of oil and gas experience to lead Eckard Enterprises in making direct ownership of oil and gas assets possible for high net worth investors. Since 2019, his company has secured $1 billion in capital across 90 projects and has acquired mineral rights, working interests, and the second largest natural gas pipeline in the Gulf of Mexico. Eckard owns interests in over 8,000 wells and has distributed over $155 million in cash flow to investors within the last 5 years alone. Troy, thank you so much for joining us today.
I appreciate you guys having me on board. Looking forward to it.
So, Troy, I think this is something that is very relevant to our real estate investor audience. I'm really excited to dive into the tax benefits of oil and gas investing because I think we're going to blow some people's minds. Oil and gas is something that I think a lot of people have heard of. They probably know little about and have maybe categorized oil and gas investing as risky because they haven't understand it, or maybe they've heard a horror story from someone. But I almost guarantee no one understands the significant tax benefits of working interest. So I want to dive into that. But if you don't mind, give us an intro about yourself and maybe making the parallel of comparing oil and gas to real estate. We'd love to hear more from you.
Yeah, I think for your audience, I'll keep this at about a 30,000 foot elevation just so we can expedite the conversation. First off, most oil and gas is considered to be real estate by the IRS. So whether you're buying mineral rights, the natural resources below the ground, whether you're participating in drilling and you own the interest directly, it's classified as real estate. It's subject to self-directed IRAs. It's subject to 1031 tax exchanges, has massive tax advantages, kind of like cost depreciation, cost segregation in regular real estate. So to make sure the audience understands, this is just another form of real estate, but it's very much on the outer banks of what most people consider to be traditional real estate, like self-storage, multifamily houses, et cetera. The parallel between oil and gas, though, is almost identical to traditional real estate in that, a real estate developer will look out and say, here's the outer loop of a city, and I want to buy some raw land, farmland, because I know in 5 or 10 years it's going to develop, and I can pay $5,000 an acre, and one day I'm going to get it annexed, entitled, and zoned, and I'm going to put in a big box shopping center, and I'm going to put an apartment complex. So there's intrinsic lifts in value as entitlement, time, and, of course, scarcity begins to take hold. Well, oil and gas is the same thing. The oil and gas industry looks for areas that they believe to have oil and gas reserves in the ground. Land companies go out way ahead of the game. They find out who the owner is. They negotiate either buying the mineral rights, buying the subsurface natural resource rights, or they'll take a traditional lease agreement, kind of like leasing an office building or self-storage space. That lease comes with rights and obligations and responsibilities to drill and develop the wells. And then once the wells are online and drilled and producing, now you have what I call a more moderate or income generating phase where the wells are produced for the next 20 or 30 years. And depending on what you pay for it, the price of commodities, you get the same kind of income generation as you would in self-storage, rental homes, or multifamily. They're just different words that are used. They're just different phases. But traditionally, if I laid them side by side, they almost have the same kind of process of recognition, entitlement, and expertise. And you know that from your business that everybody wants to be in the real estate business, but 9 out of 10 couldn't find their backside with 2 hands. So that means it takes a very specific, unique expertise to be good at what you do.
Yeah, that's great. I appreciate that breakdown and the parallel to the real estate industry. I want to talk about oil and gas investing just for the layman. Like, what are the multiple options? How can people invest in oil and gas? And then how does that compare to what you guys do? If you could just, again, like you said, 30,000 foot level, like how does someone invest in oil and gas and which specific niche are you guys in?
Well, let's just put it in simple fundamentals. Most people who have any kind of investment portfolio with some breadth to it probably don't even own oil and gas public stocks. They probably don't even own oil and gas bonds because oil and gas is hardly understood by the average investor. So you don't know if they're making a profit. You don't know if they're doing well, if they're peer-to-peer and better than the next particular oil and gas company. So what you have is this ghost industry that really is predicated by panic. Russia starts a war with Ukraine, oil goes to $129 a barrel. We better go buy some oil. President Trump comes in and says, I want oil at $40 a barrel. We better dump oil because it's going to go down to the dumps. So the first way you can invest in oil and gas is to simply start looking at publicly traded stocks. And because they're publicly traded, they tell you everything you want to know. They tell you what they're doing, how they're making money, what it costs to drill a well, reserves they find. It's like a library of information. The problem is, like a library, if you don't have a clue about that particular book in the library, it's kind of a waste of time to read it. The second thing you do is you can get to more like ETFs, and you start finding different tradable public securities that kind of do all the work for you, and you're kind of trading more of a public stock. Absent the public stocks, absent bonds, then it becomes more of an alternative and asset class, which is, how do I get involved in directly participating in oil and gas drilling or mineral rights or pipelines or producing properties? Well, for the most part, and I mean this very candidly and respectfully, I've been doing this since 1985. About 95% or more of the companies involved in oil and gas capital raising are crooks and liars, 100%. Your chances of making money in oil and gas are about 5%, and it's not the oil and gas industry. It's not the wells. It's not the technology. It's the who. And why is it so high? Why is it so bad? Because most investors don't want to learn. They don't want to take the time to figure out how the industry works and the enormous tax advantages and the enormous income advantages. They simply see it as another game in Las Vegas like Baccarat or three-card poker or craps. Because of that attitude, it allows these scam artists and these incompetent companies and these absolute bad actors who are going to go after high net worth and high income investors and convince them to invest in oil and gas using the tax write-offs as the bait. The bait is, look at this big tax write-off you're going to get. Those investors then stop thinking, they invest money, then they figure out 2 years later, I got the write-off, but I got 100% write-off because I lost all my money. That's not the game. So I have to admit, as somebody who's been doing this 41 years, it's incredibly easy business. It's incredibly hard to find the right people and the right business model. And Zach, what changes us from everybody else is because of 40 years of experience, what we've done is we've learned how to best suit high net worth investors, specifically real estate investors and other high income earners. How do we communicate with them, provide them the transparency and the education information so they can add energy to their portfolio without feeling like they're getting their arm cut off? And because of that, we allow direct ownership of mineral rights. We allow direct ownership of drilling and participation. And we do it in a way that no one else does it because of the transparency that we desire and deliver to our investors.
Yeah, direct ownership is absolutely key. And the real estate industry has no shortage of our own, gurus and crooks out there. That's just business in general. So just to share a personal story, I mean, I'm bringing you on this show here because I want to educate our audience about oil and gas investing. And as I do with most investing, I usually go out and invest my own capital. Same thing with the new markets that we want to stand up teams in. And I experiment with my own investing first to see how the experience goes before I would ever recommend this to anyone, especially our audience. Last year, I found myself in a position where anyone that listens to me consistently already knows that real estate, there's significant tax benefits. I talk about that all the time. And, fortunately, they just got much better as well. But I found myself in this perpetual cycle of always trying to buy enough real estate to offset our active income. My goal every year is to buy enough real estate to offset our income to zero and possibly even create a loss for future years. And that takes a lot of work and takes a lot of time and energy and lending to do that every single year. Well, I found myself last year in a position where I wasn't able to completely do that through real estate. And I was looking for alternative ways to invest. One of our investors had actually introduced me to your guys' company who invested with you for many, many years and had a tremendous experience. But when I learned about the tax advantages, which you just referenced, like this light bulb went off of going like, oh my gosh, this is comparable and possibly even better to real estate investing as far as like what can be accomplished with working interest investing. Not only can I offset close to all of my investment immediately, I don't have to be a real estate professional. This is investing capital into oil and gas, but I also can create this like cash flow scenario down the road. So let's hear from you, Troy. If you could just explain like what is working interest? What are the tax benefits just for layman terms, like for someone that's just learning about this? What are the tax benefits available through oil and gas investing?
Well, I'll just show you how strong the IRS and Congress feels about encouraging high income earners to participate in the drilling of domestic wells. Drilling of wells and participating in the drilling of wells is referred to as working interest. What that means is you're going to actively participate in the drilling, completion, and producing of a well. 1986 Tax Reform Act. I started in 1985. This was put in place the year after I started in the industry. That act is still in place. Here we are, 2025. That shows you how important it is. And what the IRS and Congress said is, look, domestic exploration is incredibly important, not only to national security, but also the economy of the country. So we want those successful investors out there that are running great businesses and making a lot of income. We want to encourage them to help major oil companies drill and participate in wells. And if we do that, we're going to give you front-end loaded first-year tax deductions called intangible write-offs. What's an intangible write-off? The turning of the drill bit. There's nothing left once I drill the hole, so that's a deduction. The chemicals, the fluid, the drill bits, the labor, all the things that go into drilling the well, for the most part, 75% of it doesn't exist. It's an intangible asset with no residual value. So the IRS code said you get to deduct that either in the first year or you can take it over 5 years. Well, everybody takes it the first year. Well, when President Trump got in office the first time in 2017, he accelerated the additional 30 or 35% through his Tax Reform Act 2017. He said, I'm going to let you take all of it off. Your leasehold cost, your equipment, your tanks, your truck, anything that has to do with developing domestic oil is 100% deduction. Well, now the new One Big Beautiful Bill that he passed does the same thing. So we're right back to a permanent 100% deduction on wells that are drilled in today's market. So let's just use simple numbers. If I make $1 million in income this year, based on the normalized deductions and all the little breaks, I'm running about 32 to 34% tax rate on federal income tax. If I get up to 5 or 10 million, I'm pushing close to 37 to 40% tax rate. Well, I don't want to make $10 million and turn $4 million over to the government. What I'd rather do is look at how I can not only avoid those taxes legally, but really what I want to do is create this massive income. I want to drill successful wells. So just to make sure your audience understands, if I go participate in working interest and I drill a successful well, I get the same tax write-offs. If I go drill and have a dry hole, I get the same tax write-offs. The difference is by drilling a successful well, that well should pay out economically in 36 to 60 months, cash on cash return. I have my tax benefits on that. If it's the right caliber well, I've got a well that's going to produce income every single month for 20 to 75 years without any headache. I don't have to do anything other than sit back, get my check once a month, get my statement, find out what's bought for oil and gas, and just collect the checks every month. I've been doing it since 1985. So back to what you asked me to explain, which is what are the tax benefits? They're available no matter what working interest project you get into. Here's the main thing. The IRS is really smart. They have algorithms. And so if you're drilling a well with promoter number 1 and promoter number 2 and promoter number 3, and then you have an investment with a legitimate oil company, and they all have different structured terms, the IRS knows a well drilled in that county in that state costs this much money. You're going to get a tax deduction based on the actual cost. If you go invest with a promoter and a shark and a charlatan, and they've doubled and tripled and quadrupled the price, and you take it as a tax write-off, the algorithm is going to kick out and say, you're not getting those tax write-offs. You're taking an accelerated write-off beyond actual cost. Now you're going to be audited by the IRS or have a probability of being audited or at least put in the category of review. So the working interest is a gift. It's a gift from the IRS and Congress that's almost 40 plus years old. It is a gift that is available any time of the year. Here's the important part too, Zach. I can write a check January the 1st for $1 million, call my CPA and say, I got $1 million off my gross income. Go ahead and factor in my quarterly payments, my estimates. I get a write-off day one. That well or wells can be drilled in the first half of the year, and I can start receiving revenue by the third quarter in the same year I made the investment, but I still have the tax write-off. This is what the major public companies do not get. So public oil companies do not get a write-off because they're in the business. So we as investors think about this from a financial perspective. We get to participate side by side with major oil companies who don't get the advantage of a tax write-off. They're drilling purely for the economic value. So we start off with about a 35 to 40% advantage economically than the company that's taking the lion's share of the well. That means our probability of success in today's market is pretty much a given if I don't get overly promoted or in with a bad company. Never has this industry had this before. It's only been in the last 7 to 10 years this has evolved, which makes not only the tax benefits extremely attractive, but the probability of successful wells making a lot of money for 20 to 30 years has just gotten up in that 90 to 95% factor of success. It truly is one of the most passive investments that has active income and active tax write-offs that I've seen in my entire career. It's kind of like a perfect storm of things, and President Trump just put the bow on the gift with the OBB being passed.
So when you're talking about like putting the $1 million in January 1st, is that into one well? Are y'all putting all of that into one well? Is it being diversified across 10 of them, 100 of them, 1,000 of them? Kind of how is this, how has that worked? Because obviously you don't want to put, people don't want to put $1 million in and hit a dry well. So how is it diversified, and what are the risks that are associated with it?
Well, let's start with the worst part of what you said. We haven't had a dry hole in 5 years. So we have 8,500 wells. We haven't had a dry hole. So dry holes really technically don't exist unless it's just a true mechanical failure. But being a kind of a funny, sarcastic kind of guy like I am, here's the way. I want my $1 million on one single Kentucky Derby winning horse that pays out in 6 months. But the likelihood of that happening is zero. So 40 years of expertise tells me what I want to do is I want to take a monetary consideration about how much I'm going to need in tax write-offs as my base decision. And then what I want to do is maximize my opportunity by spreading my risk across multiple wells. Why is that? It's not just diversifying. It's called being a mirror image to the majors. So Exxon may own 65%, but they own that 65% across 1,000 wells. You would think, well, Exxon would take it all, wouldn't they? No, even the majors understand the advantages of diversification. It has to do with timing, geography, infrastructure, et cetera. So what we do as a company, we will offer either maybe a 2 or 3 well package. We may offer a 20 well package. And each package has to do with the specific nuances of the wells. So we basically have 2 products. The first product is we're buying small pieces of wells that are going to be drilled, working interest, where an operator, an oil company said, hey, I'm going to go drill this well. There's 3% left. This small partner couldn't pay his bill, doesn't have the capital to drill today. He got notified, doesn't have the money. It's for sale. We buy that non-operated, meaning we're not going to control the drilling. We're not the general contractor. We'll buy into that interest and allow our clients to participate with us. We really like non-operated interest. The problem is it's kind of like shoveling sand with a spoon. You get small bites, $1 million, $2 million at a time. We started our own exploration company, Eckard Energy, because what we realized is, 1, we have an incredible team that can do it. Number 2, if you keep trying to dig a ditch with a spoon, you're not going to get very far. We found last year in 2024, the phones rang off the hook. We did about $40 million worth of capital investment in working interest in the last 4 days of the year. The phone was incredible. Why? Most investors are recognizing not only the tax write-offs, but the pure cash flow economic value. So with that being said, we have spent millions of dollars accumulating opportunities where we can control the entire drilling like a general contractor. We put our projects in 5 well programs. Our company retains 25 to 35%, and we allow the other 65% to be participated by outside investors. That investment, I believe, is a $100,000 minimum investment, which puts you $20,000 per well. Now, the key for us is twofold. Our main focus is on economic success. So we have this large inventory of drilling wells that we can propose. We hand select what we believe to be the next best 5 wells, location, permits, approvals, geology, economics, and say these 5 wells go into project number 101. We then put up together project number 2, and we take the next best 5 wells. In the background, we're out buying more leasehold, more interest, more positions, because at the end of the day, what you want is you want 100, 200, 300 locations, and you're constantly high grading to the very top of the list, the best 5, and then you offer that to your partners. Here's where most oil and gas companies make a mistake. They don't respect the money, and they don't respect the intelligence of the investors. And the investors have choice to make. They can invest in real estate and other tax-driven investments, maybe to a lesser degree than oil and gas, but they also have the comfort of this industry I understand, this industry I'm familiar with, oil and gas I don't know anything about. Because of that added risk of lack of understanding, it needs to have a more clear and larger clarity to how the investment works. So from my standpoint, it's pretty simple. Drill your best wells, take what I want as a company, offer the rest to my good partners like Zach, drill successful wells, turn them online, make your clients a lot of money. Now I've created a great scenario because next year Zach's going to have more income because the wells are producing in addition to the income he has now. And so as one of my very wealthy clients said to me 20 years ago, you're making me so much money, I'm going to have to keep investing with you forever. I go, congratulations, you figured out the perfect formula. You'll be my client until you stop making income. And that's the fun part about oil and gas. And Zach, I think this is really important. I don't look at this as tax deduction. See, a tax deduction in the IRS really means you're losing money. I prefer this as a tax deferment. So I make a lot of money off my oil and gas wells, and I make a lot of money off my company. I don't mean that to be braggadocious. I'm just saying I make a lot of income that's taxable, right? So I look at my personal income coming off all my wells and minerals, and I go, I got to shelter that. And I have income off my company. I got to shelter that. And the idea is, I know I'm going to pay taxes at some point in time, but I don't want to pay it today. I want to take the taxes I save and reinvest it because I'm smarter than the IRS and I'm much better at managing my money. And I want to keep building my net worth using the IRS's money, knowing one day down the road, I'll stop investing and then I'll pay the taxes, hopefully at a lower tax rate, or maybe it goes into a trust and I avoid it altogether. Taxes are about deferring. It's not tax evasion. It's not taking dumb decisions on investments that don't make any economic sense. It's about using the rules to maximize income while deferring those taxes to a later date. Maybe my wife's boyfriend will have to pay the tax when I drop dead, but I don't plan on doing that myself.
This is great information, Troy. It's always fun chatting with you and a wealth of knowledge. I think this is maybe drinking from a fire hose for a lot of our audience that is just learning about oil and gas. Which this is probably an episode that would be good to reference and listen to a couple of times if this is of interest to you. Let me slow down just a little bit for everyone here. I want to talk about key things that I think is very applicable to our audience. So let's just say very basic math, what someone could say they invested $100K with you.
Yeah.
Now you do need to be an accredited investor. That's important, right? Yep. But let's say someone invests 100. Let me stop there. Is there any other requirements beyond accreditation? Just like
be mentally sane and not psychotic. I think we're good to go. Yeah.
So like with real estate, we to get these same sort of tax advantages, you have to be a real estate professional with so many hours or going through a short-term loophole. This is a way where, if you find yourself paying a lot in taxes, this could be a way, if you're a accredited investor, that you could have a significant tax write-off, which is fantastic. I'll let you do the math, but very close to 100% in year one if that's the way you want to go. But let's say the accredited investor, they invest $100K with you. What is the anticipated tax deduction that year? And what is an annualized return that they can expect, say, in performing well in year 1, 2, 3, 4, 5? Could you just answer those simple questions?
Yeah, I feel like I'm in a lawsuit, so I'm going to keep it 60 seconds or less because I talk a lot. Ready? I write a check for $100,000 today. Immediately, I'm going to get somewhere between a 70 and 100% tax deduction. Notify my accountant, made the investment. It's available under the IRS code. The oil company will take that money, put it into an account along with the other partners, and then begin to spend that money on the well or wells that are being identified for drilling and participation. It normally takes somewhere between 6 months and 12 months for the wells to be drilled, completed, equipped, turned to sales, first sale of oil and gas to take place, and revenue to begin. We've had them happen as fast as 4 months, and it's taken as long as 12 or 13 months because these are $10 million per well. But an investor who makes the investment today can get that tax deduction immediately. And then when the income starts, let's call it 9 to 10 months down the road, they're going to get their very first check, but it's going to be for about 90 days worth of production, the sale of oil and gas, because it takes about 90 days to process it and sell it. So your first check's going to be a pretty nice check. We see those checks coming anywhere from 19% to as much as 40% return first check. That's what we've seen over the last 5 or 6 years. Because the wells we drill are really high-pressured wells. They've been stimulated, meaning we've overpressured the reservoir. So they kind of come in like shaking a big 3-liter Coke. They come in with a lot of production in the first 1 to 2 years. So I invest, I wait 9 months, I get my first check, and all of a sudden I've got a check 19 to 30% is typical what we see. Our average rate of return is over 80% return in the first 36 months. We've had wells pay out in less than a year. We've had wells pay out 4 or 5 times their money in 5 years. Our slowest performers are going to pay out in about 5 to 6 years, and that's just because the well maybe not as good, maybe it's more gas than oil, maybe gas prices are lower. But I would say out of all the wells we drilled the last 7 years, we probably only have 2 wells that I can see probably will take longer than 6 years to pay out. So our average return is over 35% return on investment per year average. Our overall return's over 81%. And we basically have 2 wells I consider not to be good wells out of probably 100 wells that we've drilled. I think that's a pretty simple scenario for a $100,000 investment. Now, from the reporting side, Zach, it's really easy. These are direct ownership. You're not in a partnership. You're not in an LLC. You're not in a general partnership converting to a limited partnership. You're going to sign a purchase sale agreement. We're going to manage and do all the work for you. The reason that's important is it gives you the ability to sell it one day and do a 1031 exchange from your sale of your working interest back into real estate if you want, or back into something else. You can't do that through a partnership. Also, as a direct owner, you're not waiting for a K1. You will basically get a 1099 for the income you make. We'll give that to you on or before January 31st. Then we'll give you a Schedule C or a tax summary that says, here's all the deductions that are taking place in the well. You can tie that back to the cost. And therefore, when you submit it to your CPA, it says, here's what I invested. Here's the cost. Here you go, Mr. IRS. I did everything according to the rules. I've got black and white to back it up. Audit me if you want. I'm as clean as whistle as you've ever seen. Now, that is an advantage that 99% of most oil sponsors do not have because they do them in partnerships, LLCs, or general partnership conversions. We don't like all the flavor. We don't like all the fluff, and we don't like a document this thick that protects the sponsor. We want to say, look, you're my partner. I own a piece. You own a piece. We're going to manage it for you. That's how simple this is.
Yeah, direct ownership is essential to protect yourself, I think, as you just mentioned. So I'm going to paraphrase what you just said, try to make sure the audience caught this. So and again, I'm doing this with you guys as we speak, and I have invested in the past, and this is something that I would recommend to at least consider. And I want to talk about the risks of oil and gas investing as well. I think you already alluded to this early on, that the biggest risk is the person. And I would say that's true of pretty much anything you invest in, especially real estate. But someone invests $100K, they do need to be an accredited investor, but beyond that, there's no additional requirements.
Correct.
Of that $100K, they would expect year one, they could get anywhere between 70% to 100% tax deduction that year. So that's $70K to $100K of the $100K invested that year. And that goes again, that's not a passive deduction, that's an active deduction against all income sources. Just like we do talk about doing cost segregation with bonus depreciation on real estate. And from that point, you would expect anywhere from, I think you said your average rate of return per year is 35%, but it sounds like whether you're being paid back to 36 years, that's roughly 15 to 30% return per year from the capital that the well produces. And so in my mind, at least when I invest,
income, yes. It's active income, yes, sir, every month.
All right. So if I'm going to invest $100K with you guys, great. I get that $100K deduction, which could be, whatever it is, $30,000 or $40,000 of actual taxes I would otherwise pay to Uncle Sam and never see again. But then I would expect that hopefully within 3 years, possibly 6, between that 3-6 year timeline, I would get all my money back to make me whole, plus the tax deduction. And then from there, the well could potentially continue to produce income for, it could be, what's an average timeline that you said that an average well produces?
The average well drilled horizontally in these different geological basins, Zach, are expected to last 20 to 75 years. So what happens is each well might have, let's say, 600,000 barrels of oil equivalent. But when I get to about 200,000 barrels of oil, I'm kind of break even. That leaves me the remaining 400,000 barrels produced. But like a shaken 3-liter Coke, it's going to lose some fizz in that first 24 to 48 months. But all of a sudden you have this natural decline, and that decline goes out 25 to 30 years. Here's the kicker. But if I look at wells I drilled, let's say 15 years ago, I was getting paid $32 a barrel. I've had the benefit of $145 oil, $129 oil, $80 oil, natural gas, almost 5, 6, 8, 10x of what it was. So when I look at production today, I'm getting almost as much money today as I did 15 years ago when the well first came online because of commodity prices. So there's a decline in production, but the value proposition per barrel of oil or molecule of gas has exponentially increased. So absent what most people think, that I'm going to buy well, get my money back, and then it's going to be this minimal producing well, is not true, which is why Exxon paid $60 billion for Pioneer. What they see is reserves in the ground, long-lived wells, monthly revenue, and that value of those reserves just keeps going up over time. Therefore, it means more money to you and I long-term, and that's all after tax because we've taken the tax write-off in year one. I will correct this. I say 70 to 100% because I want to be very conservative. I want to say last year under the Tax Reform Act of President Trump, we were averaging close to 95 to 100% tax write-off. I talked to my CFO earlier today. I said, what are your real thoughts? He goes, it's probably going to be 100% tax write-off based on the new OBB. The problem is there's a lot of uneducated CPAs out there. There's a lot of people in the accounting world that don't understand taxes, and they'll take each individual, interpret their own tax provision. And if you don't have a good CPA, you're getting shortchanged because you only took a 70% write-off. You could have taken 100%. So we provide all the tax codes. We provide all the information. We do a lot of educating of CPAs and accountants because we want your CPAs and accountants to be very, very smart. And so we're going to give them every tool they can to say, this is a conclusion that I should be able to take 100% this year. But there are some accountants out there who are not really in the know.
Yeah, that's how I run the numbers, and how I'm basically anticipating it is a 100% tax deduction from, the full amount that I invest in, whether it lands at that or very close to it. It's, it's a significant tax savings either way. So 100K invested, very likely close to that 100% tax deduction year one.
Yep.
Maybe slightly less, but you have a good chance of that. Very likely to get return of capital, roughly 3 years, and then a long-standing well. And this is where inflation is your friend, as you just mentioned, long-term, right? As prices go up. So very interesting concept. I want to talk about the risk because this is very exciting. People are probably going, oh my gosh, I want to jump on this. We want them to be well-educated. As you mentioned, oil and gas is a unique industry, not something that we would ever recommend putting all of your money into, right? But for the right person, the right partner, and the right diversification, this could be a very crucial strategy for many people, as it has been for myself. Let's talk about 1031 exchanges. We have a lot of people that have real estate. They have equity. They're not going to refinance it because interest or whatever. They're going to sell it at a gain. How does 1031 exchanges work with oil and gas mixing in real estate in the mid?
I personally would not use a 1031 tax exchange from traditional real estate into working interest, but I would put it into mineral rights because mineral rights have virtually no cost, no expenses, no capital calls, and it's established producing income from day one, generating 10 to 30% cash on cash per year with a 25 to 75 year life. I want to take my traditional real estate, make a nice gain, do a 1031 into mineral rights, which is real estate, buy it directly through a purchase sale agreement, and sit back and collect checks for the next 30 years. That's a smart investment. I don't want to put it into working interest, even though it qualifies, because I got a lot of tax write-offs in the working interest. Plus, there's a chance that maybe the wells are not as successful as maybe buying mineral rights. What I really want to do is take 1031, go into mineral rights. I want to take that income, which is passive, plus my ordinary income, and I want to buy as much working interest as I can get to reduce my tax liability. And if I just don't want to hang on to producing wells because I own working interest, let's say 5 or 6 years down the road, the IRS says after 3 years, you have no tax recapture. So if you want to sell it after the 3rd year, you can go sell your working interest and maybe you'll get 3 to 5, 6 years cash flow, take those dollars and do a 1031 exchange back into minerals or 1031 exchange back into traditional real estate. I'll give you a prime example. We did a well 2 years ago in January, and one of our partners is a petroleum engineer, used to work for the Texas Railroad Commission, writes a check in January, well comes online in April, really good well. His first distribution in November was 89% return on his money. I get this call. He's like mad as a hornet at me. I'm like, what are you so mad about? He goes, I can't get a tax deduction this year. You gave me back 89% of my money in the first check. I don't have any losses. I go, well, I'll drill you a dry hole next year. You'll get plenty of losses. I said, you're yelling at me for making almost all your money back in a check? And he goes, well, what do I do? I said, well, what does every successful investor do? Redeploy the capital, drill more wells. And thank goodness we have an industry right now that drills so many good, successful wells. We had a Wells Act this month, was the first check out the door. It was 28% return first check. Just went out 2 weeks ago. So the key to this is the risk is really about the who. And I think the second risk is, and this is when you want to identify this for your investors or at least your clients and the people that are watching your audience out here. The real thing is it's how you structure the venture. So we do all of our wells at cost, which means the wells budget $8.5 million. It comes in $8.7 million. Well, we all split our share of the cost of $200,000. Your cash call might be $200 because we took 5% of the well. Eckard normally takes 25, 35%. The reality is we've actually sent checks back. So we're the only company I know of that drills at cost. When the wells come under budget, we send you money back. When the wells come over budget, we usually have a contingency that allows us to offset that. Now that's really, really important because you're getting the highest value of income and asset value in those reserves relative to what you invest. And because of that, our interest is directly aligned with yours. We want that well drilled as the lowest price possible because we save money and you save money and we can take the savings and drill more wells. That is also a very strong indicator of best tax management processes. Why? I can show the actual invoices. What I show the IRS, they match. Any IRS audit says this is the cleanest operation I've seen. Have a nice day. I've never had an audit. I've never had a deduction disallowed. I never had a client audited because any investment in my firm in 41 years because of the way we do it, ever.
Nice. You mentioned kind of the oil prices changing and, how Trump's wants to bring it down and all of that. So does that mean that my monthly checks are going to change kind of as they vary? Because having lived in Texas, I've seen the boom towns and the, lack of boom towns. So does your cash flow go up and down every month, or is it consistent, or what are you looking at there?
I can guarantee you every May your check's going to be 10% lower because that's February's production, which has 10% less days, right? I can guarantee you that during winter, natural gas prices go higher. So the gas part of your wells are going to get premium prices because it's wintertime. Crude oil prices may be lower. The key to this is that the way we make our economic models is we factor our model based on $60 oil and $3.50 natural gas. The reason we do that is the one thing I don't control is commodity price. So I know President Trump wants us to drill, baby, drill. His real goal is to almost get us right to the cusp edge of looking like we're in deflation or recession so he can refinance the $9 trillion in treasury. So he's pushing like a son of a gun to lower interest rates. He's pushing like a son of a gun to get oil down below $60 a barrel. The problem is the major oil companies have as little debt as we've ever had. That creates a scenario where we're simply saying we're not going to drill more wells. We kind of control the supply side. So for the fifth week in a row, oil production's down, drilling rigs are laid down, and we're saying we'll just sit back and collect our checks until you decide you're going to pay us a fair market price. Fair market price is probably $85 a barrel. In the meantime, to answer your question, every single month will be a different volume of oil and gas. Let's say we put on some brand new wells this month. They're coming in at 1,000, 2,000 barrels a day. We might make 30, 40,000 barrels from a first month production. Those wells the second month will probably make 10% less. It's about a decline curve of 40 to 60% the first year. But by the end of the first year, I might have 80% of my money back. I'm way okay with that. And that's where the major oil companies have really taken hold in domestic exploration. They understand they can put $1 billion to work in drilling wells and get it back in 12, 14, 18 months. How many times would you turn money over if you could take $1 billion and rotate it every 14 or 18 months and end up with income producing wells as fast as you can, which is what they're doing. So commodity prices are kind of a double-edged sword. It cuts both ways. When Russia started the war with Ukraine in March of 2022, we were running about $75 a barrel, $2.25 for natural gas, right? Russia starts the war. We go to $129 a barrel and gas goes to $14. For the next 8 months, we made as much money as we normally would have made in 24 months. So you kind of get it's like a Cracker Jack box. This month they open up and Zach goes, "Ooh, my check's 15 grand." Next month he only goes, "It's 11. What's going on? Somebody steal my oil?" And when you finally understand the process, unlike a fixed tenant rate for a condo and apartment or something like that, this gives me the ability to say my average over 12 months might be X, but I get a lot of spikes. And I've enjoyed 40 years of watching oil go from $9 to $145 a barrel. And I can tell you one thing, I like that Cracker Jack box because it's always in my favor. I always get a check. I get it every single month. And I love cash flow. So that's a very strong component regardless of the price I'm paid.
Troy, who is oil and gas right for and who is it wrong for?
It is wrong for control freaks. If you're a day trader, you're a very active real estate sponsor, you want to go build your own buildings, you're a developer, you're not going to like oil and gas because you like doing everything within your own confines. And most likely, you can probably make better returns doing your own thing, right? What we have as a perfect oil and gas investor, believe it or not, we have retired engineers and geologists and oil and gas executives and lawyers because they could never invest because they work for oil companies. They were prohibited. We find that we attract a lot of analytical people, engineers, consultants, bankers, financial planners, believe it or not. We have a lot of farmers and ranchers because they're used to watching grass grow and they are very patient. So waiting 12 months to get a check doesn't bother them. At least they're not getting beat up by hailstorms and droughts. We find that we have a pretty large audience of doctors and dentists. So probably 700 partners that are doctors and dentists. Why? A lot of income, no tax write-offs. And they've been involved in real estate. They kind of have a portfolio niche in real estate. And they're like, how do I offset inflation? How do I get passive income? How do I get 1031 exposure? So my personal answer is this. You need somebody who wants to understand. Now, I don't need to make you a geologist. You got to at least understand. We have created probably the greatest state-of-the-art app that anyone in alternative assets has created. It's called the Eckard Insights. And I decided to spend the money and time because for me, I don't get serious about an investment till I kind of get my head around it. And I said, how is somebody going to invest in working interest or minerals? And they go, well, what drives the income? Well, it's wells. Well, how's the well doing? Oh, I don't know. Well, where is it drilled? I don't know. Well, what's it located? I don't know. Where's the records, the permit, the filing? I don't know. I don't know doesn't work with most people like you and I. We want answers, right? And we're not afraid to roll up our sleeves and you tell me where it's at and I'll dig and I'll find it. So we created an app called Eckard Insights. So once you become a partner, you now have your access 24 hours a day to your account. It shows you every well you own. It's recorded, it's deeded, it's titled, it's production. We scrape the data every single day. You get your tax information, your revenue statement. And why we did that is We knew that in order to attract sophisticated partners who really want to make this part of their cornerstone portfolio, we got to give them transparency. We got to give them same things we want. I just want data. Now, maybe I don't care after 3 months what the well produced because, I figured it out. I like the system. I got better things to do. But maybe I'm a retired engineer and I want to know every barrel of oil and I want to see the price differential from month to month and I want to run equations. You know what? It's so much data, you can do it till your eyeballs pop out. But because of that, it creates a kind of what we call a virtual Eckard partner who's right and who's wrong. I bet I do not get a call once a quarter from 75% of my partners. They figure it out. They meet us. They come to our conferences. They know who we are, kind of like your investors, your people, your audience. They know who you are. And once they're comfortable, like, it's just whether I want to do it or not. That's the kind of part. We actually have to fire clients. We fire some clients like, I want to know every day what it produced. I'm going to ask you another 500 questions, and I want to know, what dinosaur died in that hole. And you're like, man, I can't help you. I can't do that kind. I'm not breastfeeding you. I got to do something else. By the way, folks, I have a sense of humor. It may be a little work, but that's just kind of my personality.
It's certainly appreciated, and you're giving us a wealth of information and knowledge here, Troy. We appreciate your time. Just a couple more questions for you. Again, I think this is something that people are just going to have to listen to multiple times. I mean, let's throw up Adam, or we'll have Daniel throw up where if people want to learn more, what's the next step for people? I still got some questions for you, but I mean, you have a great team that will spend time with people to further their education on this to help them understand and break it down for them, right?
Yeah, what we did is we started with 8 people about 8 years ago, and we slowly built our team. And the first number one priority was I wanted to hire some individuals as wealth managers. And all I want them to do is take the time to talk to investors, find out what you need, what you want, make sure it's appropriate for you, and give you choices and inform you what's going on. So you just go to EckardEnterprises.com, which is our website. You can actually log on to the app. You don't have to tell us you're accredited. You don't have to give us your social security number. It accesses our app and it has literally hundreds of hours of videos. Every time I get a question on any subject, I do a training video. I do that because you get to choose what's important to you. So once you get on the website, EckardEnterprises.com, or you call the 800 number. The 800 number has been around since 1991, 800-527-8895. I am old. I'll be 61 tomorrow. And so when you do that, you say, hey, look, I don't know what I need or what I want. I want to know about how to get tax runoffs. I want passive income, I want active income. Then one of our wealth team will contact you. They're paid a salary. There's no bonuses, no commissions, no fees. They're paid to service your needs. This is like the Ritz-Carlton level of service. Once we determine what you need, then we're going to tell you, well, these are the different investment opportunities and portfolios that are available. And you come and go at your own speed. We're probably the most laid-back firm you've ever met, simply because we're building a relationship. This isn't about selling you an investment. I know that sounds corny, but that's how I feel about it. And as a result, we will take and teach you and educate you. Zach, the other thing we do that most sponsors will not do is we always host our own events. So we have an annual conference. We invite every partner, regardless of net worth or investment size, said, come to our conference. You can meet another 200, 300, 500 other partners. Ask any question you want, meet our entire team. If I'm lying by 3 days later, Sunday, you're going to beat me like a piñata. If I'm telling the truth and all the partners confirm that, you'll probably be a partner for life. So far, I've done it for 28 years and I haven't been beaten like a piñata yet. So those are the little things that we do that assure you access is available, information is available, credibility, due diligence, it's all there. I think we stand head and shoulders above virtually any other sponsor out there when it comes to that kind of exposure.
Yeah, absolutely. This has been so great, Troy. I mean, that's a great point, right? If you're getting all your investors over 40 plus years into a room every single year, and everyone's still happy and satisfied, well, they're there for a reason. And some of those have been long-term partners. And I, like I said, I personally invested with you guys on multiple projects, had a great experience. I think this is a very interesting piece that can fit into your portfolio potentially. And there's, significant tax benefits available. So just to kind of summarize some of the key points and takeaways that I took from our interview with you is that, all right, let's say the accredited investor invests $100K. There's a good chance that you could get very close to that $100,000 in tax deduction first year. Meaning you invest $100K, you immediately get close, potentially all of that as a tax deduction against all your income sources. You don't need to be a real estate professional. And you could very likely get a high rate of return to get your capital back, a 30, 35% return per year. You may be delayed in that first, for 12 months or whatever it is. But the goal is to likely get a large portion or all your capital back within the 3 years. And then you're just, infinite returns past that, right?
Correct.
There's 1031 exchanges available. There's multiple different ways you could set that up. What I heard from you is if you have physical real estate, likely 1031ing into mineral rights, which is a very good cash flow
Correct.
Cash flow investment, you don't have the same tax benefits, but then you could take that cash flow and then buy working interest to, also participate in the working interest and tax benefits. Is another thing, another way that people could, participate with real estate. Troy, is there anything we forgot that you think is worth mentioning just as we tie this up for investors, or any kind of final parting words for our audience?
Yeah, I will tell you this. There were several things that President Trump just did that are going to make a dynamic shift in the supply, demand, and value proposition for commodities. Number one, he pulled out all the subsidies from wind and solar. So for the last 10 years, people have been going after wind and solar farms and wind farms. And the downstream user of that wind energy and solar energy are now going to find that they're going to go broke. They're no longer economically viable. So you're going to have this huge shift back to oil and gas and fossil fuel from wind and solar because they're going to go broke and they're no longer subsidized, right? Also, because of artificial intelligence, we're looking at 30 to 50% increase in the electrical use as a result of AI. That's all going to come from natural gas. Plus, we now have the largest liquefied natural gas exportation taking place with about $500 billion investment along the coastlines of the United States, shipping liquefied natural gas abroad. So underneath the toe of everything you and I talked about is we have the old traditional economics 101, supply and demand. Well, demand is up as high as it's ever been. It's record demand this year at about 102 million barrels of oil a day. We have record demand for liquefied natural gas and gas products, and that's increasing dramatically with everything I just described. And then we have something else that's taking place right now that most investors are probably not even thinking about, and that is if you look at the historical economic pattern, from 2002 to about 2012, the U.S. dollar fell dramatically from $118 for the U.S. dollar value down to about 72. We currently have declined from 115 on the dollar. Now we're at about 97 and some change today. If you look at the pattern, every time the dollar decreases and weakens, price of oil escalates dramatically. So even though we're seeing a current suppressed price at $65, if I'm just strictly an economist and I'm looking at it strictly from the numbers, we're in a pattern of a delayed pendulum swing back to higher prices as a result, not because just strictly supply and demand, but it's a monetary policy change, which means a weaker dollar means much, much higher oil prices. So as you're looking at your portfolio, if we're all really smart investors, we're thinking to ourselves, we're going to go buy the best traditional real estate, get it with an arbitrage, get it at a discount. When everybody's looking right, I want to run left. Well, the smartest people are looking at oil right now because they realize this isn't just about increased demand. It's a monetary decision. It's going to take a lot more dollars to buy that same barrel of oil than it did last year because of weaker dollar. That means we're going to see escalating oil prices over the next 12 to 36 months, which is probably why you saw these major mergers last year with Exxon buying out Pioneer, Chevron buying out Hess, ConocoPhillips buying out Marathon. It's all that's taking place because they're positioning themselves for a rapid rise in energy prices over the next 5 to 10 years. Just thought I would throw that as a side note. So whether you invest with me or you go buy energy stocks, you need to have energy in that cornerstone. One way or the other, it's going to benefit your overall portfolio.
Fantastic. Well, Troy, thanks so much for joining us today. Again, Troy is the chairman of the board for Eckard Enterprises. You can go to the link that's in the show notes to find out more and see everything they have to offer, schedule a time to talk with them, and figure out exactly whether or not this is the right investment for you. Again, that link will be in the show notes below. If you're looking for physical assets to get in 1031 into some mineral rights, to 1031 into some oil and gas investments, you can head over to renttoretirement.com. That's renttoretirement.com. As always, if you have any questions that you want us to pass along to Troy or for Zach and myself to answer in future episodes, or if you want to come on and tell your story about investing in real estate, email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate y'all spending some time educating yourself on a new type of investment. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.